What's up everyone, it's Kadi with MoneyVest. So in this video, I wanted to cover the report that came out from JP Morgan talking about how they see a over 23% drop in the S&P 500 to come down to 3,500 in the middle of 2024 on the back of a recession. So hope you all enjoy this video and find it helpful. If you do, make sure that you drop a like. I also want to basically revisit one of our analysis and one of our videos I did about a year ago, talking about how the markets react and respond after the first rate cut and around the last increase as well, because it kind of feels like we're already done with the rate increases, right? Because the market's obviously been pricing in rate pauses for the last couple of months, and they're pricing in for rate cuts starting in March of 2024 as well. So I'm going to go over that chart and kind of draw some conclusions, some comparisons on how the markets respond to all those different environments. Again, make sure that you drop a like, subscribe to the channel if you haven't already. Links to our Discord and Patreon is going to be down below. Would love to have you on board as a MoneyVest member. You get access to all the trade alerts, Discord channels. You know, we've been crushing it with the bond trade. We've been crushing it with a lot of other swing trades as well. And of course, you get access to our members only private videos, Excel spreadsheets. Everything's going to be included with a link down below. So going over to this right here is the report came out yesterday. So JP Morgan charts Guru sees 23% drop in the S&P 500 by mid-2024 on the back of a recession. And they're expecting that the S&P 500 is likely to tumble to 3,500 points by middle of 2024. And again, they are the head of technical strategy, and they see a crash. They see cash and treasury bonds are safer bets than stocks today. Now, look, there's obviously going to be some sort of reasoning behind this, and the main reasoning is that the market is apparently mistakenly pricing in a soft landing for the U.S. economy, where the Federal Reserve succeeds in crushing inflation without causing a recession, is what they mentioned, and investors will soon realize the outlook is darker than they thought, sparking a sell-off in stocks, the bank's head of technical strategy said. Now, what I've mentioned before in my previous videos is two words: repricing, risk. Okay, repricing is one word, risk is another, and the market carries that right now. As we are sitting here in December 2023, markets carry that repricing risk. Okay, it's a risk. You can't see it, you can't actually feel it, but it's there. It's there because the market's pricing in five rate cuts is what's baked into the S&P 500 right now. We're at close to 4,600 because the market's pricing in 5 rate cuts. Now, the interesting thing is, if that happens, great, right? That's already baked into the price. If it doesn't happen, that's the repricing risk I'm talking about, okay? If the Federal Reserve next year does 2 rate cuts or 1 rate cut or 3 rate cuts or 0 rate cuts, that's going to open the market up to repricing all of that information, okay? That's the risk that I'm referring to. And that's, I think, is what Jason is also talking about. The markets are mistakenly pricing in a soft landing, and they'll soon realize the outlook is much darker than they thought. Now, I'm not saying that the outlook's going to be much worse and the market's going to sell off. I'm not saying it. I'm just saying that there is repricing risk the market carries. So if expectations change, the market's obviously going to reprice and change accordingly. Now, he also mentions that you tend to find your way into a bear market that's eventually associated with a recession way more often than not, and the odds are stacked in favor of a hard landing, actually, which means that inflation may come down, but a recession will follow. We talked about the 3 market scenarios in one of my other videos. Definitely do check that out, because in that video, I talk about the 3 potential market scenarios going into 2024, a soft landing, a hard landing, and a no landing. And he says that we're going to have to go to stall speed. That's what enables the Fed to start easing in the second half of the year. The market's going to have a significant gut check of whether inertia is going to carry to recession or not. Stocks should pull back as well. And he said the benchmark S&P will likely slump to 3,500 by the middle of next year in a retest of the lows of 2022. And of course, cash and 2 to 5 year treasuries look far safer to him than equities today. Now, this is another point that I will agree with. So there's only 2 things that I agree with in this report. Number 1, there's a repricing risk the markets currently carry, which I already covered. Number 2, equities don't look as attractive, relatively speaking, on a risk-adjusted basis relative to bonds and maybe even cash. I mean, you're getting online savings accounts, certificate of deposits, fixed income market, which is the bond market. So 6-month, 3-month, 1 year, 2 year, 5 year. Of course, the longer you go out on the curve, the higher the maturity levels and all that, the terms of that bond. But even the short end of the curve looks very attractive, right? We're looking at 4, maybe 5% yields on an annualized basis versus the earnings yield on the S&P at under 5%. So there's only two things that I do agree with. Yes, stocks look a lot less attractive relative to bonds in this environment right now on a risk-adjusted basis. And there's a repricing risk the markets carry because the market's expectations are 5 rate cuts that's already baked into the actual S&P 500 level, 4,600. And if that changes, then the market's going to be vulnerable to changing expectations and obviously pulling back as well. Now, this right here is the video from a year ago where I talked about how S&P 500 responds to rate cuts and rate hikes. And this right here is the market's performance after the last rate hike, okay? Again, I'm going to say that again. This is the S&P 500's performance after the last rate hike has been completed. And you'll notice that this right here is, I believe, 1970s. 1970s, this right here is going to be 2000s. This right here is going to be 2007, 2008. And this right here is going to be 2019. And this was 2022. Of course, we were seeing significant amount of rate increases. There was no certainty with where the Federal Reserve is going to stop. So we continue to see a pretty significant sell-off, very similar to what we witnessed in the 2000s. But 3 out of the 5 instances, when the last rate hike was complete, the market rallied hard. 24% in 1970s, again 15% in 07, 08. Well, after the sell-off, of course. And then, of course, we got 23% in 2018, 2019 as well, when the Federal Reserve was indeed done raising interest rates. Because the thing is that when the Federal Reserve is actually very, very quick with quantitative easing and very, very slow with quantitative tightening, right? So they're like extremes. They go very fast when it comes to cutting rates because they want to fight in a recession. They want to fix something. So they want to do it very quickly and they drop rates down to 0. But on the other hand, when they're tightening, when they are aggressively taking liquidity out of the economy, they do very, very slowly. They go very slow, as we have seen over the last 18 months. It took us 18 months to get where we are at over 5% when it comes to interest rates. One more thing I want to point out is that when the Federal Reserve is cutting rates, right, there is a certainty, okay? One of the only things the markets hate is uncertainty, right? Not knowing what is going to happen, right? But when it comes to cutting interest rates, there is certainty because we know the Federal Reserve is going to cut rates potentially down to 0%. That's the floor. They're not going to go below 0%. They can't go below 0%. So that's the floor. But on the other hand, when they're raising interest rates, there is no certainty, right? There's a certainty gap. So we don't know how high the Fed's going to go. We don't know whether it's going to be 4%, 5%, 6%. So the market's going to be a lot more uncertain in an aggressively quantitative tightening environment than it is going to be in a very aggressive quantitative easing environment, which is why quantitative easing kind of creates this environment of a bull market and the market's rally versus quantitative tightening. Now, this right here is talking a little bit about what happens when the Federal Reserve makes that first rate cut, okay? And in 3 instances, what you'll notice is the markets have rallied on the back of that first rate cut, okay? Only twice, 2000s and 2007, 2008 is when the markets dropped pretty aggressively. But I would argue that these 2 instances kind of blindsided the market and the economy very much, right? We had the tech bubble in 2000s and we had the 07, 08 global financial crisis and the real estate bubble. Some people knew, but majority of people were not aware of what's going on in the housing market. And as a result, it kind of blindsided the economy, blindsided the investors, the Fed. And as soon as they started cutting rates, the damage was already done, right? So as a result, the markets dropped 54%. In 2000s, they dropped over 28%. And this right here is, I believe, 2019 after the rate cut. Of course, there was a lot of quantitative easing. The markets ripped, from negative 24% to over 30% as well. So the point that I'm trying to make from this screenshot is if the rate cut is coupled with a recession, okay, and depending on how severe that recession ends up being, in the short term, it's possible the markets sell off, but that's also going to create a very strong buying opportunity. And then as rates continue to come down, that's going to create an environment for stocks to rally eventually because quantitative easing, as we know, is very helpful for the market. But if rates get cut on the back of no recession and inflation is indeed down and there is a soft landing, then that's going to be a very strong performance from the market on the back of rate cuts. And in that scenario, I don't expect the markets to pull back, but simply, don't expect the markets to see a sell-off, big significant sell-off or a bear market or crash, maybe a little bit of a pullback and then starting to rally once again. Because one of the things that we have discussed in our previous videos is the Federal Reserve needs an incentive. They need something to fix, okay? They need a reason to cut rates. If they don't have a reason to cut rates, they will not cut rates, okay? They need something to fix. in order to cut rates. So let me know your thoughts down in the comment section below. There's a couple things that I want to again mention from this report that I do agree with: repricing risk and stocks being a little bit more unattractive relative to bonds and cash on a risk-adjusted basis. But to say that the market's going to drop 23% on the back of a recession is still uncertain. Like, we don't know what's going to happen, right? I have no idea whether there's going to be a recession or not. There is probabilities. I do believe that probability for a recession are slightly higher than us avoiding it, given how high the rates are, and there's a time lag. But it's just a wait and see approach, and then of course trading in the market that we're currently in based on the risk rewards that we see most optimal in the markets. So hope you all enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.